Well, welcome everyone. We will be discussing mortgage fund versus trust deed model and why the transition with Brock. All right, so first I kind of want to give you a brief about Verivest and who we are before we get started. So we are a real estate investment platform designed to bring trust and transparency to middle market investing. So we are connecting deal sponsors with accredited investors through our marketplace, shortcutting the time to trust. All right, so here we have the sponsor directory. So you can go on verivest.com. You can search for a sponsor you would like to invest with. You can search by MSAs, by minimum investment type. You can see the background check of all the principals involved in the deal, and you can also connect with them directly through our platform. So those are all great benefits of the Verivest platform. All right, oops. And then the verification requirements. There's the verified gold members, and then there's also Verivest verified members. So to be on our platform, you have to have no personal or business bankruptcies, no unfavorably resolved lawsuits, no regulatory sanctions in the past 7 years, no felony criminal convictions, and have signed the code of conduct.
And I think TaliMar Financial is a verified.
Oh, let's get to it. Here we are. Here is TaliMar Financial, and he is a gold member of the platform. Yep. So that is the highest level of transparency. So that means the sponsors agree to have all their active opportunities monitored on an ongoing basis to prove they're following the rules of the deal's operating agreement. So here we have TaliMar, and they are super transparent for you guys, and they are private lending.
Yeah. No, I appreciate you having us on your site. Really enjoyed kind of going through the verification process. It's a huge help for us when we talk to investors, and we bring in the Verivest name. Not only you kind of discount yourself here because Verivest does so much more than just this for us, but it is a huge part of when we sit down and talk to investors is just getting them comfortable with who we are, especially investors that have not that don't know anything about us. So thank you very much for allowing us on your platform.
Yes, it is our pleasure to have TaliMar on our platform. And then as well, sponsors can engage us to verify their track record. So you can see assets and investment types and the inception dates as well as investment amounts. So we verify all of that for you so that you can see it up close and personal, and you don't have to guess how long they've been doing it, and you can see all of the numbers there. All right, so I know that was pretty brief. Thank you, Brock, for kind of giving a little more color to what we do here at Verivest. If you would like to connect with me, here's my phone number, my email, and then you can join the Verivest community network too. There's a link on the bottom. And then I would like to introduce our guest today. Brock established TaliMar Financial in 2008. He funds on residential and commercial private money loans. He's funded over 650 loans totaling over 250 million. And he services a loan portfolio of over 90 loans totaling over 50 million. So without further ado, I will give the floor to Brock. And then as we go along, if you guys have any questions, feel free to drop them in the chat, and then we'll do a Q&A at the end, and Brock can answer those for you. So I'm going to go ahead and stop my share and give the floor to Brock.
Sounds good, Brittany. I just want to say, number one, thank you again for reaching out to us and giving us an opportunity to host a webinar with you. Verivest has been a huge help as we launched this fund back in April. One of the big things that we have focused since 2008 in doing when we launched TaliMar Financial is really provide a transparent platform for investors to invest in trustees and the loans that we originate. And when we were looking for partners, Verivest kind of hit every question that we had, given a platform to ensure that when we launched this fund, investors would feel comfortable with what we would do. I think one of the biggest difficulties in launching a mortgage fund right out of the gate is how do you get the investor confident in what you're doing? Now, luckily, we've been doing trustee investing since 2008, so we do have a decent sized following of investors that have been investing with us on trust deeds. But the question goes, when you start to transition into kind of more of a sophisticated investment model, how do you get people confident in what you do? And Verivest does not only does the verification process for us, does the background checks, but they act truly as a fund administrator for us. So they're doing all the financial accounting for us every month and at the end of the year to ensure that we stay compliant with the rules and the regulations. So Brittany, thank you very much. And then Dylan's not on the call, but Dylan is our counterpart over there. And man, he does a lot for us. So thank you. Well, when Brittany and I were first talking about doing a webinar, there were a couple options that we wanted to talk about. I could have first come out of the gate, Brittany, and said, hey, let's just plug the TaliMar Financial Mortgage Fund and tell everybody how great we are and kind of loans we do. But I imagine you get a lot of people that do that. And I wanted to kind of explain why, more than just why TaliMar Financial and TaliMar Income Fund 1 might be a good investment option for you, but why we made a transition from a trustee model to a mortgage fund model and why we think it's a better option for our investor community. So for about the next 30 minutes, I want to talk a little about what the trustee model that we created, what it does, and then how we transitioned into that mortgage fund and why you may want to follow us into that mortgage fund model. So as I had mentioned, I want to just do a quick introduction on TaliMar Financial, though Brittany did a wonderful job for us. Thank you. Give you a little overview of trustee investing. Some people here on the webinar might not know what a trustee investment is, what it is, some of the advantages and disadvantages of investing on a trustee model. Then talk about the mortgage fund investing and how that's a little different than the trustee model. Talk about its advantages and disadvantages. And then jump into the TaliMar Income Fund 1 and kind of details and the nuts and bolts of what we're looking to accomplish with the mortgage fund, and then open it up for questions and answers. I honestly could talk about this for 4 straight days. I love it so much. I could get really into the weeds of trustees and mortgage funds. So if I get too in detail about something or you don't understand something, please feel free to, I believe you have the option of raising your hand or submit a question to me. I'd be more than happy to stop and answer that question. So I'll go ahead and actually open my trust or the chat function. Brittany, if you could also help me out and if you see any of those questions.
Yep, I'll monitor the chat for you.
Thank you so much.
Yeah.
All right, so let's go ahead and get started. Let me tell you a little about myself. I'm a graduate from the University of Michigan in Ann Arbor. Spent 4 very cold years. Actually grew up here in San Diego, but had a lot of family back in Michigan. And so I had the opportunity to spend 4 years in Michigan and loved every moment of it. Out of college, I started work as a financial analyst for KeyBank here in San Diego. My main responsibility was to underwrite residential development projects and had a blast doing it. It was a great opportunity, grew the ranks. Unfortunately, 2006 and 7 rolled around and KeyBank decided that it wasn't a space that they wanted to be in at the moment, and decided that they were going to go ahead and look as an alternative, look at other options. So in the meantime, I had an opportunity to do what's called a 2-year engagement with the FDIC. So if any of you know or watch 60 Minutes for those teams that would go into failing banks on a Friday evening, shut them down, and then bring them up as a new bank on the following week, I was part of that team. So I would go in on a Friday evening. We would effectively shut the bank down, underwrite the entire bank, all the loan portfolio and whatnot. And then we would actually sell off all the bad loans to investors, and then bring that bank back to the community. So it was a great opportunity for me to kind of see the inside guts of a failed bank and why it failed, and look at that loan portfolio. So it was a great opportunity. Got a chance to travel the country looking at these banks. During that period of time, I started to invest or lend to real estate investors that were buying houses from the foreclosure sales, primarily here in the San Diego market. I didn't even understand, or there was even a kind of a private lending industry. I was just lending money to some of these investors that I had met. It was a successful platform. In fact, I had other investors that wanted to invest in the loans that we were originating. And that's essentially how I built TaliMar Financial. So from the first loan that I funded myself to where we are today. I live here in San Diego with my wife and 3 beautiful children. And I actually play competitive tennis. So if I'm not here in the office, you're going to find me on the tennis court. So I enjoy that. Tell you a little about TaliMar Financial. As I mentioned, we were established in 2008. And the whole premise is that we were funding what we call fix and flip loans, or loans that investors would purchase and renovate properties and then sell. To date, since 2008, we've funded over 650 loans, totaling over 250 million. We currently service a loan portfolio, so we manage over 90 loans, totaling over 50 million. I have an office of roughly 3 people here in San Diego, and then I have a full IT team that handles all our software development to manage our portfolio in India. Currently, we focus on funding residential and commercial private money loans in the Southern California market. We like the Southern California market simply because, number one, it's in our backyard. We get to see all the real estate that we're lending on, and typically get to meet the borrowers that we are lending to. We launched a trust deed model in 2018, or portal, excuse me, in 2018. And I'll get into, again, what trust deeds are, but effectively, for those that are currently investing in trust deeds, we launched a portal in which you could log into our website and view all the trust deed investments that we had available. We launched this in 2018 simply because just the sheer number of investors that were contacting us and wanting to invest in the trust deeds that we were offering was becoming overwhelming. And so we designed and developed a software package that investors, like I said, could log in, could view all our trust deed offerings, subscribe directly to that trust deed, and then can watch that trust deed or manage that trust deed through its entire life cycle. So from the day that they fund that loan through the entire time until that loan pays off. It was a great success. In fact, it was too much of a success where I thought that we could handle and manage our existing investor platform or base. I bet you since 2018, our investor base has probably grown by, I don't know, maybe 300 to 400%. And so as we made it easier and easier for investors to view our trust deeds, we just got more and more investors on the platform. So end of 2020, we decided just with the sheer amount of capital that we had to invest, we were looking for a better strategy to invest that capital. So instead of taking individual trust deed investors and marrying them with individual trustees, we decided, okay, it's probably a better strategy at this point to pool investor capital and then lend that pool of investor capital out on the loans that we currently already originate. The idea was to mirror our existing portfolio of trust deed investments with the income fund. Additionally, as we did our review of the mortgage fund, we found out there's some significant tax advantages as well by investing through the fund, and I'll get through those tax advantages as well. And so that's kind of where we are today. So I want to quickly just briefly go over what a trust deed investment is. And for those that have not invested in trust deeds, what are the advantages and disadvantages of investing in a trust deed? So as a trust deed investor, the best way to explain it is that you are the lender. You are lending money to a borrower. Now, I'm going to talk about being a trust deed investor in California. There are different rules and regulations in every state about investing in trust deeds, and even some states are mortgage, or we call mortgage states. So I'm just going to talk specific about investing in trust deeds in California. So as a trust deed investor, as I mentioned, you are a lender and you're lending your money to a borrower. Now you're lending your money to the borrower, but using real estate as collateral. So if that borrower fails to make a payment, theoretically, you can foreclose on that property, sell that property, and get your money back. That is the basic sense of what we do. We lend money using real estate as collateral. The reason why they call it trust deed investment or a deed of trust investment is simply that you are securing the loan that you're funding with a deed of trust on that property. So that borrower goes to sell that property. That deed of trust is recorded on that property and is not released until they pay off that loan. Simply a deed of, that's a trust deed investment. So generally what happens is when you do that loan, that borrower is going to make you make payments on a monthly basis, depending upon how you draft the loan, and make those payments to you until they pay off that loan. That is a trust deed investment. Now, there are some kind of nuances in trust deed investing, and one of the biggest nuances is that you don't have to fund the entire loan. You can do what we call fractional trust deed investing. So for example, the average loan that we originate here at TaliMar Financial is roughly $500,000. Well, a lot of our investors don't have $500,000 to invest in any one trust deed, or they choose not to want to fund all of their $500,000 in a single trust deed. So they do what's called a fractionalized trust deed. So in basic sense is if we had a $500,000 trust deed and somebody wants to invest $100,000 in that trust deed, they become a 1/5 owner in that deed of trust. And then they earn the income based on their ownership in that deed of trust. And that's important because it's similar to what you do on a mortgage fund level, but in this case, you're recorded directly on that deed of trust as the lender. Now, the advantages of a trust deed is, number one, it's a fixed monthly income. So in most cases, you're going to structure a loan in which the borrower is going to make a monthly payment to you. Number two, you're secured directly on the collateral. So if I were to look at that property and look at the details on what's recorded on that property, I am going to see a document, the deed of trust, with your name on it. So that you know that in order for that borrower to sell that property or convey their ownership of that property to a new owner, they have to sell or pay off that loan. And it says your name directly on that deed of trust. So they have to pay you specific or that to repay that loan. Trust deeds have attractive yields. Obviously, for those that have been investing in trust deeds, we've seen those yields come down a little over the last couple of years. But if you're looking at a basic first trust deed, so first position loan at, let's say, 65% loan to value on a property here in Southern California, expect to earn about 7% up to maybe 8.5%, depending upon the risk of the borrower. So it's a decent it's an attractive yield if you're looking for monthly income. I call it a moderate risk profile. So if you're doing it right, you're taking not outlandish risks on your trust deed investing. You're sticking to 50% to 70% loan to value on your loans. And again, I'm kind of skipping over a lot of stuff. So if people don't understand the term loan to value, please let me know and I'll go more into it. But if you're taking moderate risk on these loans, it's a moderate risk profile investment, I would say. Other basic advantages of a trust deed investing is that you can invest in your backyard. So you can go out, here in San Diego, I can go look for investors that need to borrow money for their real estate investment projects. And I can invest on a local level. I can see the real estate, I can meet the borrower, I can get comfortable with kind of the neighborhood that the collateral or the property that I'm lending on, where it is located. And once I close on it, I can drive to it. I can see what the current condition of that property is. Another advantage that we talked about is you can fractionalize a loan. So if you have a large loan of, let's say, $500,000, I can invest $100,000 in that loan. You can actually invest less, but a smaller portion of that entire loan. Now that could be a negative and that could be a positive. Negative being that is now you've shared an investment with 5 other people, and they could be strangers. And if the loan goes bad, you may have some issues in trying to figure out what you're going to do with the loan. Or it could be a good thing in which the borrower continues to make the payment, and you just have to own a small portion of that loan. And then the other benefit is that you can use your self-directed IRA to invest in trust deeds. And I'd say about 30% of our investor base uses a self-directed IRA of some type to invest in our trust deeds and our mortgage fund. Now, there are some disadvantages of using a deed of trust to invest in investing in a deed of trust. Number one, the biggest disadvantage, and I think I lost a slide here, but one of the biggest disadvantages is that by investing in a single deed of trust, if that borrower stops making payments, your entire income stream is lost. There's no more income on your investment. Also, if the borrower pays off that loan and you receive your funds, you are no longer earning any income. You're now having to go out and find your next deed of trust. And in today's competitive market, it's extremely difficult to place money in another trust deed. I get probably 2 to 3 calls a day these days from investors looking to place capital in trust deed investments. We just don't have the volume for the amount of capital out there. So that's another disadvantage of doing a one-off trust deed model, which is probably one of the biggest reasons we did make a transition from a trust deed model into a mortgage fund model. The third disadvantage on a trust deed is that, yes, you're recorded on the deed of trust, but if something goes bad, you're on the hook as the lender, and most likely any litigation on that deed of trust is going to come at you. And so you're going to be responsible for handling that litigation directly. So let's skip to the mortgage fund and what is a mortgage fund and how is it different than investing in an individual trust deed? Now, the concept is the same. As a mortgage fund, we are a lender. We're lending money to a borrower. We're securing our loan with a deed of trust, and that borrower is making a payment to the mortgage fund. So the idea is exactly the same. The big difference is the investor and how the investor invests in the mortgages. So instead of investing in each individual mortgage, you, the investor, are now pooling your capital, and that capital is now lent to the borrower. That borrower sees, in this case, TaliMar Income Fund 1 as the lender. We manage the entire loan portfolio just as we had done before on the trust deed model, using the same partners that we have to service our portfolio. And then at the end of each month, when all those payments come in, we then disperse those payments off to the investor. So very similar type model. The only big difference is the investor is investing in the mortgage fund versus directly in that trust deed. Now, let's talk about some of the advantages of investing in a mortgage fund. So number one is fixed monthly income. So same as a trust deed investment, you are earning a monthly income by investing in the mortgage fund. Number two advantage, and I think this is probably the most talked about advantage, is the qualified business income tax deduction. So all the income that's generated from a trust deed investment and a mortgage fund investment is considered ordinary income. Now, the way we structured the mortgage fund with a REIT, it's considered a pass-through entity. And with the 2017 Jobs and Tax Act, the government and IRS had rewritten the regulations to state that you could qualify for a qualified business income tax deduction, stating that only 80% of the income generated from a mortgage fund, the way we structured it, is actually taxable. The remaining 20% is a non-taxable event. That's a huge advantage for some of my higher net worth investors, which is one of the bigger reasons why they have now transitioned from a trust deed model into a mortgage fund model. Now, you'll have to talk to your CPA about if you qualify for what we call QBIT, but it's definitely something to take into consideration if you are deciding, should I continue with a trust deed model, or should I get into a trust deed model, or should I go the mortgage fund route? The third biggest advantage, and I think this is for me is the biggest advantage, is diversification. So as a trustee investor, I'm no longer locked into one trustee or maybe one or two trustees. My investment is diversified over a portfolio of trustees. So if one trustee goes bad, my entire income stream doesn't evaporate. I have income from all the other mortgages that the mortgage fund is invested in. Same with payoffs. So if I have a loan that pays off individually as a trustee investor, again, all the income is evaporated from that investment. However, in a mortgage fund, if one loan pays off, you've got the entire portfolio of loans, other loans that are continuing to make their payments. And I hate to use the term dead time, but that's what I call it. It's what we call dead time between loans. So if you get a payoff in a loan, that money goes back into your account, you're earning no income. It's called dead time, until such time as you identify another trustee to invest in. Now, one of the advantages is that you're secured on collateral through the fund. So no longer is your name on that deed of trust. If any litigation were to occur, that litigation goes back to the fund, not you individually. And there have been, especially recently with COVID and some of the regulations that the state of California and other states have put in place, there's some risk associated with lending right now on real estate, which is kind of a caveat or asterisk. That's why I always suggest, if you're investing in trustees, use a loan servicing company that specializes in investing in trustees or doing private money loans. And I can, if you want to contact me, I can refer you to a couple companies that we currently work with. Again, the advantage of a mortgage fund is an attractive yield. Today, in today's environment, it's very hard to find any type of investment that offers a decent income. A mortgage fund offers a very good monthly income. Similar to a moderate risk profile, again, we consider a moderate risk profile. Our mortgage fund, we try to focus of staying loans within a 50 to 70% loan to value ratio. Let me get this out of your way here. Get that out of the way. Again, most of the loans that we are originating within the mortgage fund are going to be invested locally. So again, we're going to continue with the same model that we've been essentially, or that was we created and established since 2008, that same type of underwriting model, we're going to continue using into the mortgage fund. And again, you can invest with your self-directed IRA as well, which is great. So people that have self-directed IRAs that might be having trouble putting their funds in individual trustees, this might be an option for you to invest in a mortgage fund and essentially remove any issues of trying to jump between trustees as they pay off. All right. So let's talk about some disadvantages of the mortgage fund. Number one, the biggest disadvantage, I think, to some of our investors is that you have to be an accredited investor. And what is an accredited investor? An accredited investor is someone who has a net worth of 1 million or over, exclusive of their primary residence, or can show income over the last 2 years of $200,000 individually or $300,000 with your married spouse, and expect to earn that in the next year. The other disadvantage is the ability to liquidate during extreme market volatility. Now, this same risk exists with deeds of trust. You can imagine if there's extreme market volatility like 2007 and the housing market collapses, you anticipate that your funds are going to be locked up in the mortgage fund until such time as you have what we'll call a liquidity event, or you start to have some mortgages pay off, or you have more investor capital coming in. So those are the two main disadvantages of a mortgage fund. Any questions thus far? I see one question here.
Yeah, so Michael had a question that says, when FED tapers and interest rates go up eventually, who knows when that will happen, will the fund follow suit and also raise percentage rates on trustees? If rates rise 100 basis points, how will the fund react to that rate hike,
Yeah.
just for example, and time frame of the changing rates?
Yeah, that's that number one question for my trusted investors right now. Where do we see rates going? And obviously, I can't predict where rates are going to go. I've been anticipating that they're going to be raising rates over the last 2 to 3 years. It just hasn't happened. But yes, I mean, we're going to, as rates go up, we should anticipate the return on trustee investments in the mortgage fund yields to go up as well. I will say though, it isn't an overnight process. What most likely you're going to see is that as rates start to creep up, you're going to see a higher demand for capital, which obviously with either a lower supply or your supply stays the same, the higher demand goes up, the price of that product is going to go up. So what I think is going to happen is we're going to be stagnant with the amount of investor capital we have, and we'll be able to pick and choose what loans we do. And those loans that we're going to be picking and choosing to do are going to have the opportunity to have a higher rate. So that's kind of how I see it. Do I see overnight we're going to see 100 basis point change in rates? No, but I do anticipate, over a 12 or 24 month period, assuming rates are, slowly creep up, you should see that filter into the private lending industry right now. But I hear you right now, rates continue to be at rock bottom, rates for trusted investors. And that's a long conversation that I have with a lot of my investors, but great question. Okay, so let's talk about why the transition. So again, as I had mentioned earlier, we made the transition we launched the fund in April of 2021, but we decided to move forward in developing and creating the mortgage fund in late 2020. And the reason we did is, number one, we had too much investor capital chasing too few trustees. And from about 2008 to, let's say, late 2019, we didn't really have a difficult time mixing in or rolling over investor capital as trustees were paying off. But early 2020, we started to see just a huge influx of capital coming in to invest in our trustees. I think number one reason was just the amount of capital that was going after trustees. Number two, we had this trustee portal option that investors could just literally at any time log in and see what trustees we have available and subscribe directly there. So it made the process of investing in trustees much quicker. If you're interested in learning, if you're not currently on the trustee portal, my suggestion, go to our website, TaliMarFinancial.com, and I'll show this to you. Select the investor link, and I'll show you how to sign up and start to view some of the trustees that we have available. But that was just the sheer number of investors coming in was one of the biggest reasons we made the transition to a mortgage fund model. The other issues that we had is in order to scale in this business, it was really hard to do a large number of loans and try to find investors for every single loan. So if I looked at my office, we could probably max out 10 to about 15 loans in any given month. Anything bigger, you just got to add headcount. And it becomes an inefficient model of trying to place all the investors. Everybody's kind of on their own schedule, looking for their own kind of trustees to grow the business. So we thought, okay, what is a more efficient model to bring in investor capital and get that capital out the door in new loans? So here are kind of some of the bullet points of why we decided to change or make that transition. Better market acceptance. And what I mean by better market acceptance is as you go as a hard money lender and we go out to originate loans, we have two markets, or generally two markets, maybe three markets to go to. You can go directly to the investor and market to the investor, which is what we do here in San Diego. But you can also market to the mortgage broker platform. And the nice thing about the mortgage broker platform is that there's just such a larger availability of loans. And a lot of the loans that come to you, assuming the broker is good at packaging his loans, are very easy to understand. You put in a nice little package. You can say, yes, I'm interested in doing this loan, and this is how I would price out the loan, versus working with an investor who may not know how to package a loan or provide you any loan, the loan information. So when you work with the broker community, they're more interested in working with an established mortgage fund. The reason being is because they know that they're talking to the final decision maker. Now, in our case, if you brought a loan in, I could probably tell you if I could do the loan or not, just because I know my investor base pretty well, but I still have to go back and get approval from my investor base. And then once I get their approval, work with them to get their funds into the loan. There are plenty of cases where we were ready to close a loan and either one of my investors went on vacation for a week and couldn't fund the loan. They missed the cutoff period for a wire. They were using their self-directed IRA to invest in the loan, and the self-directed IRA custodian we just couldn't get a hold of or wasn't working quick enough. So there becomes kind of this difficulty in making sure that the timeline works with one another, which is why a lot of mortgage brokers prefer to work with mortgage funds. And when you get that market acceptance from the broker community, you get access to a better loan. So better real estate, better borrowers, better terms and whatnot. So we recognized that and said, okay, let's go ahead and go after those better loans. Let's create the mortgage fund. I kind of talked about it. I just talked about reduced the uncertainty during the funding process. We have a standard set of loan documents. We have a standard set of servicing documents. We have a standard set of processes that we've gone that over the last 12 years, we've just developed. They work. We're confident in them. We're confident in the attorneys that drafted our documents. And too often, we have investors say, okay, well, I don't like that part of your servicing agreement and try to modify it, or, they don't like the closing process. The closing process was moving too quickly for them. And so it created some uncertainty, especially when we were trying to increase the loan volume that we were doing. It created some uncertainty. And by creating a mortgage fund, you create more certainty in the closing process. We increase investor return by reducing loan servicing costs. So, if we outsource our servicing, and when I say servicing is when we close the loan, we have a third-party servicing company service our portfolio. And the reason we do that is, number one, the rules are changing all the time, especially in the state of California, and what you can and cannot do. And it's nearly impossible for a mortgage broker to be able to be on top of all the regulation changes. So that's why we decided, okay, let's go ahead and outsource that function. Number two, it's a costly process. You have to have specific software. You have to have someone dedicated to managing that software. You're collecting payments as they're coming in. They have to be processed, and then they have to be sent out to all the investors. And so that is a significant overhead for you to take on. Just easier to outsource that process. That servicing company specializes in collecting payments. In our case, we work with FCI Lender Services out of Irvine. And that's what they do. They collect, they have, last time I checked with them, I think they had $5+ billion that they were servicing in hard money loans. And so the cost to do that is nominal. It's a small amount of money per loan. However, as you bring more and more investors in a specific loan, the costs do rise dramatically. So by having one lender in a loan, TaliMar Income Fund 1, we've reduced the servicing costs, which in return increases the investor yield. Fourth bullet point, and I talk about this right here, is the frustration from investors with the ability to invest. Unfortunately, I've had investors that have been with me for 10+ years, and up through about 2019, I've been able to always get their money as one loan paid off, we'd be able to get those funds reinvested. However, just with the amount of capital we have, I started seeing that period of time, we call it dead time, start to increase. So investors were starting to get frustrated that we were not able to reinvest their funds quick enough. Offered a more diversified investment platform. And so in sitting down and talking about the mortgage fund with the investors, one of the biggest advantages I wanted them to understand is that now with the mortgage fund, you can diversify your investment over multiple trustees, not just a single trustees. And I think a lot of investors understood that and felt that probably was a better model for them when they, as opposed to investing in trustees. Significant tax advantages. And this is that 2017 Jobs and Tax Act that I was talking about, and the qualified business income tax deduction. So that when the distributions occur from the mortgage fund, assuming that you qualify as an investor, only 80% of that income is taxed. The other 20% is not taxed. And that's a significant advantage for some of my investors. And then for us, just to streamline the investment process. So when a call comes in on a new loan opportunity, I can quickly qualify that loan. I can ensure that we have the funds available for that loan in our mortgage fund, make sure that it meets our credit box of the mortgage fund, and then move forward and close that loan. So those are the main reasons we decided to make that transition. So let's just talk about the mortgage portfolio today. What does it look like? So generally, our lending guidelines are aligning with exactly what we've been doing on the trustee platform. Number one, we primarily focus on first trust deeds. I think that's primarily what we're going to be on. Though if a second position loan that makes a lot of sense, we'll go ahead and add that into the portfolio. As I mentioned, we're trying to stick with between about 50 to 70% loan to value ratio in our portfolio. Right now, I believe we're about 63, 64% loan to value. But we do have the option to go up to 65% of current value. Now we do fund what we call fix and flip loans. That's why I use the term after repair value. And so we will underwrite to the after repair value of that property. Now, one big thing to qualify that with, that doesn't mean that the borrower has no funds in the transaction. The borrower will always come in with their own capital on the purchase of that property. It just simply means that we are going to provide them most likely funds for the renovation of that property. We'll go ahead and disperse those funds to the borrower over the course of the renovation so that we ensure that that property gets to that after repair value. Loan terms are going to range from 12 months up to 60 months. I think right now, most loans that we underwrite are going to be 12 to 24 months. 12 months for usually our fix and flip loans, 24 months to 36 months for our bridge loans. I personally like longer term loans. I think it creates a more stable mortgage fund. You don't have a lot of loans coming in and loans going out, so that you're always constantly having to find more loans for the portfolio. It's just easier to handle a portfolio that's more stable. Loan types, as I mentioned, we fund bridge loans and fix and flip loans, and then some new construction. We don't do a ton of new construction loans, but big question I get is, what's the difference between a bridge loan and a fix and flip loan? Fix and flip loans, typically we're underwriting to future values. The borrower's intention is to buy that property and renovate it such that the value is going to be greater once they're done with the renovation. A bridge loan is simply underwritten to current value. The borrower's intention is not to do any type of renovations, or at least any renovations isn't going to go into our underwriting of that loan. Bridge loans they may be using simply because they need to close quickly. Their conventional lender can't fund quick enough, so they're going to use a short-term bridge loan. Maybe it's 6 months, 9 months, simply to purchase that property, maybe stabilize it, and then take us out or pay us off with conventional bank financing. Maybe they want to refinance an existing higher cost hard money loan, get that rate down on it. That might be a 12 or 24 month bridge loan. That just simply means it's for a shorter period of time. Property types. If you looked at our portfolio right now, I think 95% of it is single family or small multifamily being 1 to 4 units. We really like the residential marketplace. That's what we market to here in the Southern California market. I feel like it's the most stable asset class to be in. But we do have the opportunity within the fund to do small balance commercial loan, industrial, retail, and some land. Our focus right now, just due to the sheer size of our fund, we're just really kind of Southern California, more San Diego centric. But we have the option as we grow this fund to start looking at loans along the West Coast. Some offering details. And we do offer an executive summary. If you're interested in learning more specifics about this about our mortgage fund, I'll show you where you can go onto our website and request the executive summary and get access to the PPM through the Verivest platform. So number one offering is, its name of it's TaliMar Income Fund 1. Offering size is up to 250 million. Minimum investment is 50,000. Now we structured our mortgage fund with what we call a 6.5% preferred return. So any income generated for the fund gets paid out to the investor up to 6.5%. Anything above that gets split 50-50. Now I want to asterisk that. Right now, we have waived that 50-50 split. So any income generated by the mortgage fund, 100% gets paid out to the investor. Now you're going to ask, well, Brock, how do you make any money off the mortgage fund? Number one, we earn our income on the front end with with points, and then we also take a servicing spread. So the purpose of the servicing spread, not only to cover the cost of us managing the portfolio, but it also, we don't get paid from a servicing spread if the borrower doesn't get paid or if the borrower doesn't pay. And so we're kind of in the same boat as the investor, trying to fund loans that the borrower's intention is to obviously make the payments on that. The investor target yield for the mortgage fund. So again, we're focused on first trustees in the Southern California marketplace is 7.25%. That was considering the 50-50 split. Again, we've waived that 50-50 split. And I think right now, over the last 3 months, we're averaging about 7.75% yield to the investor. Distributions are made monthly. Right now, we don't have a management fee. The management fee was replaced with a profit split. We do take a loan servicing fee. I think right now, the option is up to 1.5%. I think right now we're about 1% on average on the loan servicing fee. You have the option to reinvest those funds. So a lot of self-directed IRA investors that don't want those payments to come back, you can go ahead and request that you can reinvest those funds into the mortgage fund. We have the option to leverage. That's a big question that we get. The intention of the leverage is not to increase the yield of the mortgage fund, however, just to stabilize the invested capital. So right now we have about 3.5 million in the fund. To ensure that that 3.5 million is always invested, we may tap a line of credit so that and to fund a loan, so that if one loan pays off, we can just take the proceeds from the payoff, pay down the line of credit. So we're always at that 3.5 million in invested capital. And as it grows, keep it as high as we can in terms of the invested capital. Redemption, another big question. We have up to a 90-day written notice option for redemption. For those that have not invested in a mortgage fund, the question becomes, okay, what if I need to get my funds out? How quickly can I do it? Typically, we say it's about a 3-month process. Keep in mind, in order to get paid out of a mortgage fund, there has to be a liquidity event. And that liquidity event is going to happen in 3 ways. Most likely that you're going to have a loan pay off. And so once that loan pays off, then we can distribute those funds back to the investor that's looking to take a redemption. You have investor capital coming in. That new investor capital coming in will pay out the investor that is looking to redeem their funds. Or third, you can tap the line of credit, assuming it's available, and distribute those funds back to the investor by tapping that line of credit. This is a Reg D 506C fund, which means that I can go and market the fund generally out to the market. I see that a question popped up.
Yes. So the question is, what happens if lots of people want money back at the same time?
Yeah. Again, people that were invested in a mortgage fund in 2007, I'd also say within COVID, you had this issue. So you had a lot of investors get a little concerned about the marketplace and decide, okay, maybe it's my time to take the funds out. And that can become an issue for a mortgage fund. So let's say that you have a mortgage fund and 50% of the investor or 50% of the funds invested want out. Well, you're going to have to wait longer than a 3-month period. Typically what happens is the fund manager decides, okay, we're locking up the fund. Your funds are going to be locked into the mortgage fund until such time as those funds become available, and that you're not creating a or you're not, there's no threat to the mortgage fund that that you would not be able to return all the investor capital. So imagine if there's a huge crisis, anticipate that your funds are going to probably be locked up, and not just this fund, but any fund that you're invested in for a period of time until that manager can release the funds. In our case, enough of the loans were to pay off so that we could return the funds. Good question. Okay, so where are we today? Now, keep in mind, we launched the mortgage fund in April of 2021. Our goal was to raise $3.5 million by year end. We've already surpassed that. High percentage of the investors that are investing in the fund today have been investing with us for a long period of time on our trustee model. And so what we're finding as trustees pay off, they're deciding, okay, we're going to go ahead and take those funds that we received and place them into the mortgage fund. The fund has currently 13 loans, totaling 3.8 million. I'm going to ask, okay, well, where's that 300 additional thousand? That's an example of us using our line of credit to ensure that that 3.5 million always stays out invested. So that as a loan pays off, we pay down the line of credit, but 3.5 million still remains outstanding. Average loan to value ratio is at 63.2%. So right now it's almost mimicking what our trustee portfolio looks like. So at 63%, we feel that's a good loan to value. The average yield on the portfolio right now is 7.71%. So you're earning 7.71% on a portfolio of 63.2%. All loans in the portfolio are performing. Veravest is the mortgage fund administrator for our fund. And what does that mean? That simply means that we have outsourced the whole financial component of the mortgage fund to Veravest. So they actually physically do the day-to-day, month-to-month, and year-end financials of the fund. They're booking all the income of the fund. They're booking all the new investors that come in the fund. In fact, they're actually doing the accreditation process for us as well to ensure that the investors that are in the mortgage fund are actually accredited investors. So we've outsourced that entire process. That gives us the ability to simply focus on originating, underwriting approved loans, and then funding those loans, and then servicing that loan portfolio. As I mentioned earlier, and I've stepped down here, FCI Lender Services is the servicing agent. So we actually don't even collect any of the payments. Those payments go to our servicing agent. That servicing agent then makes the payment distributions to the mortgage fund. Veravest books those funds, and then they go ahead and provide all the monthly statements. In fact, when you log in and look at the fund and get accredited, you're actually going through the Veravest platform. And so it's a cool platform. So kind of we're coming to the end of this, and I want to talk about kind of what the focus of the lending platform is. And I've kind of had this focus since we established the company in 2008. I had the opportunity to sit down and work with some of the hard money lenders that did not make it through the 2007 crisis. Many of them got stuck with loans, large land development loans, either Central California, out in Arizona, Nevada, got stuck in some large construction deals, stuff that very complicated transactions. And one of the takeaways in sitting down with these groups is focusing on security over yield. Now, occasionally I'll get calls from investors, and and the conversation goes something like this: Brock, for your trustees, what are your typical yields? And I'm honest, typical yields are between 7 to 8%. And the response is, well, that's really low, Brock. I'm looking at 10 and 11% yields on trustees. And right away I can say, well, based on our portfolio, getting those kind of yields, you have to take significant risk. And I find that you're better off focused on creating good security or getting involved in good trustees than trying to chase yield. So when I say that is, Number one, am I comfortable with the real estate that I'm underwriting to? So am I confident that if the market were to turn south, the value hit to that real estate would be limited? Number two, if I were to have to take over the real estate, can I liquidate it relatively quickly? And number three, do I actually understand the real estate that I'm lending on? So it's kind of one of those keep it simple thought processes. I love single family houses. I get it. They don't offer the best yields on trust deeds sometimes, but you know what? I understand single family. I understand multifamily. And so we're going to kind of stick and focus on those assets that we understand. Focusing again, strong underlying assets, as I mentioned, really sticking with the single family, multifamily. We do have the option. I mean, I funded a small in the fund, a small commercial loan, but the underlying asset of the location of the commercial asset, the future opportunity for it, it was just a great asset. Number three, and I think this is a misnomer in the hard money lending industry, that being a hard money lender, we don't do credit checks. We don't check income statements. We don't check the ability to pay. And I don't run a hard money firm like that. I want to see, number one, the borrower has decent credit. I understand there's explanations on why a borrower may have poor credit. But I find, and it's based on my experience, that borrower isn't going to make their credit any better over the period of time. And, you know, it's kind of an attraction of always having problems with credit. So I like to try to stick with borrowers with decent credit. Number two, that they can make the payments on the loan. Now, I'm not so interested in understanding or showing, you know, their bank statements or something, or I'm saying their tax returns or something, but I want to understand how they're going to make the payments on this loan. So it could be bank statements that they submit, or they can have a story of, you know, showing income from the property that they're renting that's going to be able to make my payments. And then we talk about clear exit strategy. So when I do a loan, I want to understand how am I going to get repaid. And in most cases, the repayment process is going to be the future sale of the property, being that we do a lot of fix and flip loans. But if it's a bridge loan, you know, why is the borrower going hard money on that purchase or refinance? Maybe it's just maybe it's a quick purchase and they already have another lender, conventional lender in the works. Okay, well, show me that you have some type of pre-approval from that lender showing that you can take us out. Show me a clear exit strategy where I'm going to get repaid. One of the things that I think today there's an issue in the market is market knowledge. And when I say market knowledge, is sub-market knowledge. Do you understand the markets that you're lending in? The market here in San Diego is very different than the market in Los Angeles, which is very different in San Francisco and Sacramento. Now consider a lot of hard money lenders are trying to go national. So they're trying to fund loans in Los Angeles. They're trying to fund loans in Nashville. They're going down to Miami, popular places in Phoenix, or Arizona and Texas. And what I'm concerned about, and I'm not going to suggest that they don't know what they're doing, but you have a tough time understanding each market and having the knowledge base in each one of those markets to start confidently lending in them. If I was going to be lending in a market like Los Angeles and San Francisco, I'm going to want to acquire somebody in those areas that are going to not only be originating the loans, but understanding that marketplace and then being able to provide me real-time data as to what's the current status in that market. I can tell you San Diego, you tell me a street and I can tell you what property, and I know everything about the San Diego market. I guarantee you I can't bring that knowledge to Los Angeles. Third-party relationships, and this is vital. And this is where I am so happy to be partnered up with Verivest, because I will tell you, being able to take the financial aspect off the plate in terms of running a mortgage fund and focusing on what we do best, which is to originate loans and then service that loan portfolio, it's a huge advantage. Again, working with FCI to service those loans. You have a huge advantage because they have the knowledge base, they have the people set up, the software, the systems to do it much better than I could ever do it while I'm trying to originate loans. So that's why we've been able to, people talk about, well, Brock, you have 50 million under management, 90 loans servicing, but you only have two to three support staff helping you do this. And it's because we've been able to outsource that component to it, as well as we've been able to develop internal software that can really create more efficiencies in originating and servicing our loan portfolio. And the other thing is investor transparency. Just being honest with our investors, making sure that you're not putting them in loans that probably are not the right loans for them. If a loan is going bad, just being upfront, hey, we anticipate that this loan is going to go bad, and this is what we suggest. We find that if you're just honest and transparent with your investor base, even if something isn't going planned, their response is going to be, you're going to get a much stronger and better response from your investor base, which is why we've developed a platform where you can view all the assets in our mortgage fund, just like we did on our deed of trust. And I'll show that to you in a second. So transparency. So those are our main items that we focus on in on our lending platform. With that, I'm going to end the presentation. I really skipped over a lot of I went general on a lot of points. If you have further questions, feel free to reach out to me. Best way to reach me is, here's my phone, 4900. Feel free to give me a call in the office. You can also email me at bvandenberg@talimarfinancial.com. I'll shoot everyone a quick email just thanking them for listening to this webinar, but feel free to reach out to me. Before you go, though, I wanted to show you what our lending platform looks like.
Hey, Brock, can I interrupt you? We have a
Yes.
question in the chat.
Yeah.
So the question says, what % of loans are second trust deeds, and how high can that percentage be?
So we
And
have
they
no.
asked the same question for the third trust deeds.
Oh, same. Yeah. So we have no seconds or thirds in the loan portfolio. And honestly, I don't really anticipate having seconds or thirds in the loan portfolio. I just don't think we want to take that kind of risk right now, nor do we have to. I've got plenty of trusted investors that would invest in a second. We're not looking to chase yields on a second. The only reason I would consider doing a second is that we're at 50 or 60% loan to value, and the borrower's just got really strong financials, and it makes sense. And the exit, and more importantly, that there's a strong exit strategy. The investor base that I have, again, isn't here to chase yield. They're just looking for a very stable investment, that they're looking for that cash flow. They're really not looking for risk. So I would say that we're not going to be doing seconds, and I can guarantee you we're not going to be doing thirds. In fact, I don't think in 12 years I've ever actually done a third. Does that answer your?
He said, what did you mean by second position? So in his original question, he said, what percentage of the loans are second trust deeds? And then said, what did you mean by second position?
Oh, same thing. So second trust deeds, when I say second trust deeds, you're simply in second position. So let's say you have a property, and it's worth, I don't know, 500,000, and they have a second $200,000 first, so first trust deed. And let's say you put a $50,000, we call second trust deed, behind that first. So that's that second position loan or second trust deed.
Thank you for clarifying.
Yeah. So real quick, I just wanted to introduce, this is the platform that we created for our trust deed investors, and that we have kind of modified to our mortgage fund investors as well. And so if you go to our website, you can go to trust deed investing, and you can go to our trust deed portal. By going into our trust deed portal, you can view all the available trust deeds that we have. Now, keep in mind that as investor capital comes into the mortgage fund, those trust deeds most likely are going to be bought up or invested into the mortgage fund. As all the investor capital is used in the mortgage fund, we'll make those trust deeds available to investors. But this is what the portal would look like. So if you were to go onto our website, you could log in under investing, go to trust deed investing, and you have two options. You can either view our available trust deed investments here on this page, and we list all our available trust deeds here, and we give you the opportunity to log in and view the trust deed. So for example, this trust deed is coming up here in Fallbrook. The loan amount $600,000. It's a first trust deed underwritten to 70% loan to value. And this is a fix and flip loan. Now, if you're interested in learning more about this loan or subscribing to it, you can simply select View Details. And once you go here, you can use your username and password. And you can view all, and once you log in, you can view all your accounts here. In our case, I'm simply invested in the REIT, and this will show all the investments in the income REIT. You could view your available trustees here, and you can subscribe directly to them. As they become available, this Learn More button will become active, and you can learn all about the trustee and invest in it. However, for those that are invested in the mortgage fund, you'll have access to a mortgage fund tab, and you can view your total outstanding balance and the account name that you're invested in. So if you invest in multiple accounts, you would have all your accounts would show here with the balance. And then it also breaks down all the assets in the mortgage fund. So you can view what all the everything that is in the fund. You notice we have 13 assets in the fund right now, a total loan balance of 9.9 million. We have ownership interest of roughly 3.9 million. And if you notice here, we're at 63% on average, 63.2% of the loan. I'm sorry, 63% loan to value, earning a 7.71% yield at the moment. And you'll have access to this. Actually, we're going to be updating this to provide more details on the mortgage fund, such as the loan types, talk about location of loans, property types and whatnot. We'll be adding to it. So you'll have access to this, and you can always view the mortgage fund, and that goes into our available transparency. Now, we also have another lender portal which is offered by VeriVest, which you can log in and view all your monthly statements. You can view all the cash flow and income statements on the VeriVest platform by logging in through their portal. And once you get invested or interested in learning more about that, I can walk you through that lender portal. With that, I think I have talked everyone's head off. Does anyone at this point have any questions? Would be interested in learning more about the mortgage fund? Have questions about our process or my background?
Brock, you will be sharing your email and contact information with everyone in your follow-up, correct? Because we have people that are interested in speaking more with you.
Absolutely. And again, I forgot to mention, if you're interested in learning more about the fund, feel free to go to our website, TaliMar Income Fund 1, and simply select request information. We'll go ahead and provide you information on it, or you can go to the VeriVest site and view all the information on our fund at the VeriVest site as well.
Cool. Well, Brock, thank you so much for your time today and your expertise.
Well, Brittany, I appreciate you, and I appreciate the whole VeriVest team that support us in managing and growing our mortgage fund. Thank you.
Awesome. Thank you all for attending, and we'll be in touch.
All right. Thank you very much.
Bye.